economic health. Apple is an American success story. Its products are justifiably well known and used throughout the world. Just like millions around the world, I carry an iPhone in my pocket. The company's engineers and designers have a well-earned reputation for creativity. What may not be so well known is that Apple also has a highly developed tax avoidance system, a system through which it has amassed more than $100 billion in offshore cash in a tax haven. Sending valuable intellectual property rights offshore, together with the profits that follow those rights, is at the heart of Apple's tax avoidance strategy. More and more intellectual property is the dominant source of value in the global economy. It is also highly mobile. Unlike more tangible physical assets, its value can be transferred around the globe, often with just a few keystrokes. The secret to Apple's business success isn't in the aluminum and steel and glass of my iPhone and other Apple products. Its profits depend on the ideas that bring those elements together in such an elegant package. That intangible genius is intellectual property that is nurtured and developed here in the United States. The key to offshore tax avoidance is transferring the profit-generating potential of that valuable intellectual property offshore so that the profits are directed not to the United States, but to an offshore tax haven. Apple's tax avoidance strategy comes in two parts. First, it executes a shift of the profit-generating power of its intellectual property to an offshore tax haven, thus directing the resulting income to the tax haven, and of course to its wholly owned corporations in that tax haven. Next, it uses a number of tactics to ensure that once this income is offshore, that it remains shielded from U.S. taxes, despite provisions of the U.S. tax law, which are designed to capture that income as taxable. Some of Apple's techniques are staples of international tax avoidance, such as its use of what is known as a cost-sharing agreement between the parent company and its offshore subsidiaries, and its use of so-called check-the-box regulations, and we'll discuss those in a moment. But others are unique. Apple has sought the holy grail of tax avoidance. Offshore corporations that it argues are not for tax purposes resident anywhere, in any nation. And here's how it works. Apple Inc. has created 3 offshore corporations, entities that receive tens of billions of dollars in income, but which have no tax residence, not in Ireland, where they are incorporated, and not in the United States, where the Apple executives who run them are located. Apple has arranged matters so that it can claim that these ghost companies for tax purposes exist nowhere. One has paid no corporate income tax to any nation for the last 5 years. Another pays tax to Ireland equivalent to a tiny fraction of 1% of its total income. The first of these companies is Apple Operations International, or AOI. And this chart, which we'll put up over here, shows Apple's offshore corporate network. AOI is at the top of the structure. Apple is its sole owner. AOI in turn directly or indirectly owns most of Apple's other offshore entities. Under Irish law, only companies that are managed and controlled in Ireland are considered Irish residents for tax purposes. Apple says that although AOI is incorporated in Ireland, the company is not managed and controlled in Ireland, and therefore is not a tax resident in Ireland. U.S. tax law, on the other hand, generally turns on where a company is incorporated, not on where it is managed and controlled. Apple says that since AOI isn't incorporated in the United States, it is also not present in the United States for tax purposes. Magically, it's neither here nor there. The second corporate ghost is Apple Sales International, or ASI. ASI, as we'll explore in a bit, holds the economic rights to Apple's valuable intellectual property in Europe, the Middle East, Africa, India, and Asia. From 2009 to 2012, its sales income amounted to $74 billion. Apple has performed the same alchemy with ASI as with AOI. It's incorporated in Ireland, operated from the United States, but Apple says is a tax resident in neither country. Unlike AOI, ASI has paid a small amount of tax to Ireland. In 2011, for example, it paid $10 million in taxes on $22 billion in income. Now that's a tax rate of 0.05%. It appears that this tiny tax payment may be related to activity unrelated to ASI's main purpose, which is to serve as a receptacle for profits generated by Apple's intellectual property in much of the world. Apple has told the subcommittee that a third subsidiary, Apple Operations Europe, or AOE, which sits between ASI and AOI in Apple's corporate structure, also has no tax home, again using the same claims about Irish and U.S. standards on tax residency. Now, Apple's exploiting an absurdity, one in which we have not seen other companies use. The absurdity need not continue. Although the United States generally looks to where an entity is incorporated to determine its tax residency, it is possible to penetrate an entity's corporate structure for tax purposes and to collect U.S. taxes on its income if the entity is controlled by its U.S. parent to such a degree that the shell entity is nothing more than an instrumentality of its parent, a sham that should be treated as the parent itself rather than as a separate legal entity. AOI, AOE, and ASI all sure seem to fit that description. Take AOI. AOI has no owner but Apple. AOI has no physical presence at any address. In 30 years of existence, AOI has never had any employees. AOI's general ledger, its major accounting record, is maintained at Apple's U.S. Service Center in Austin, Texas. AOI's finances are managed by Brayburn Capital, an Apple Inc. subsidiary in Nevada. Its assets are held in a bank account in New York. AOI's board minutes show that its board of directors consists of 2 Apple Inc. employees who live in California and 1 Irish employee of Apple Distribution International, an Irish company that AOI itself owns. Over the last 6 years, from May 2006 through the end of 2012, AOI held 33 board meetings, 32 of which took place in Cupertino, California. AOI's lone Irish resident director participated in just 7 of those meetings, 6 by telephone, and none of the 18 board meetings between 2006 and August 12. ASI circumstances are similar. Prior to 2012, ASI, like AOI, had no employees and carried out its operations through the action of a U.S.-based board of directors, most of whom were Apple Inc. employees in California. Of ASI's 33 board meetings from May 06 to March 2012, all 33 took place in California. In short, these companies' decision makers, board meetings, assets, asset managers, and key accounting records are all in the United States. Their activities are entirely controlled by Apple Inc. in the United States. Apple's tax director acknowledged to the subcommittee staff that it was his opinion that AOI is functionally managed and controlled in the United States. The circumstances with ASI and AOE appear to be similar. Now, our legal system has a preference to respect the corporate form, but the facts here present this issue. Are these offshore corporations so totally controlled by Apple Inc. that their identity as separate companies is a sham and a mere instrumentality of the parent? And if so, whether Apple's claim that AOI and ASI owe no U.S. taxes is a sham as well. AOI sits at the apex of Apple's offshore tax avoidance strategy. Apple's claim that AOI and these other subsidiaries are not tax resident in any nation is a key element in its strategy to avoid taxes on its offshore income. But how did that income end up offshore to begin with? And that brings us to a second, more common arrangement for shifting income away from the United States to a low-tax jurisdiction through what's called transfer pricing. Many U.S. companies, including Apple, use transfer pricing to shift intellectual property rights to offshore affiliates and then direct income associated with that intellectual property, taxable income that would otherwise flow to the United States where the intellectual property was developed, to the affiliate's home jurisdiction, which is typically a tax haven. Now, there are multiple ways to transfer intellectual property rights offshore, but Apple's primary method is through a so-called cost-sharing agreement. Generally, in a cost-sharing agreement, a U.S. parent or one or more of its affiliates are assigned a designated percentage of funds and resources to be applied to the development of new products that, in the case of Apple, are developed here in the United States. Apple retains legal title to and all marketing rights to the developed property in North and South America, and its offshore affiliates get marketing rights for the rest of the world. And that's a key part of the so-called cost-sharing agreement. It's more than sharing the costs, so-called, but also the offshore affiliates get the marketing rights and the profits for the rest of the world. Apple set up its cost-sharing agreement with its Irish subsidiaries. Now, I use the term cost-sharing with some skepticism, since it is obviously not an arm's-length transaction, although it's called an agreement. All the money supposedly changing hands belongs to Apple, and all the signatories were Apple employees. The agreement on its face allocates the cost to be shared among the Apple companies, but since all of those costs ultimately come out of the same pocket, in reality, the agreement is about shifting profits. The cost-sharing agreement enables Apple to shift profits generated by its intellectual property away from the United States, where the intellectual property was developed, and instead concentrate the lion's share of profits from most of the world to Apple's subsidiaries in Ireland. Again, the intellectual property that generates Apple's profits was created in the United States, but most of the profits are assigned to Ireland.